Over the past months, global markets have gone through a darkest hour. The S&P 500 has fallen over 10%, with the Nasdaq leading the decline. Not only have stocks plunged, but the bond market is also in turmoil. It seems investors have nowhere to hide. The value of many investors' portfolios have been shrinking, with gains vanishing before their eyes. Everyone is actually asking, is this the start of a bear market or a pick-up reversal opportunity to buy the dip? Here, I want to emphasize, we don't dwell on emotions, we will focus on logic. Let me calmly break down what's happening at the US epicenter of this quake, discuss what this storm means for a size in China and other emerging markets, and finally talk about strategies for how we can respond. First, from the macro level, let's look at the interest rates and the liquidity. One trigger for the sell-off is the surge in the US 10-year Treasury yield, which recently shot up and broke about the crucial 5% threshold, sparking fears of a liquidity crunch. The reason is straightforward. The Federal Reserve remains hawkish on inflation, and the expectations of a fiscal stimulus from the new government are also pushing long-term rates higher. When the global risk-free rate rises, the denominator in all risk aside, valuations expands and the prices naturally fall. Simply put, surging yields make life tough for stocks, Bitcoin, and other risk assets. Now, on the valuation front, tech stocks are undergoing a reality check of the AI hype. For the past 2 years, the market was propped up by hopes in artificial intelligence, but the last earning season revealed a harsh truth. Tech giants have poured huge capital expenditure into AI, yet the monetization of these AI efforts is slower than expected. Sky-high price to earning retails that PE of tech companies, often tens of hundreds of times earnings, have started to come down from their peaks. Investors are no longer willing to pay for a dream and are instead demanding tangible results. In essence, this is a healthy deflation of an AI bubble rather than a total collapse. Enthusiasm back to rationally. The third aspect is sentiment and policy uncertainty. In late 2025, the policy direction of the newly elected US president, such as potential trade policies or tariff threats, has cast a shadow over market sentiment. The saying, capital hits most uncertainty, is back. In this government, investors are demanding a higher risk premium, and a lot of money is choosing to pull out of the stock market and sit on the sidelines. After all, cash is king. In short, geopolitical and policy variables are chilling market sentiment and safe haven appetite has surged. So, how will the US Treasury global stock transmit to China and other emerging markets? Starting with the bad news, a strong US dollar typically creates a significant effort on emerging markets. In other words, when the dollar strengthens, emerging markets often face the capital outflow pressure. Foreign investors, in order to cover their losses in US stocks, might be forced to cut their position in the Chinese market, and usually the most liquid assets are sold off first. This means that in the short term, China, the stock market could also be dragged down. However, there is good news. During the round of turmoil, Chinese assets have demonstrated relative resilience. Despite panic in overseas markets, the Chinese offshore renminbi that CNH has remained fairly stable, and China's major stock indicates fell much less than US markets did. In other words, foreign capital outflows have not triggered a panicked sell-off in China. Domestic support has helped the Chinese assets withstand the first wave of this shock. Most importantly, Chinese assets have their own independent logic and are not in complete lockstep with Wall Street. The economic cycles of China and the US are currently out of sync. The US is grappling with high inflation and interest rates, while China is focused on stabilizing growth and maintaining a relatively low interest rate environment. From a value perspective, when US tech stocks are trading at lofty valuations, global smart money is on the hunt for undervalued markets. Right now, Chinese equity PE ratios are at historical lows, offering a considerable margin of safety. For investors with a global perspective, Chinese assets are domestically independent value. Finally, let's talk specific strategy. If you don't want to be cut down like leaks, big losing retail investor, you must keep a close eye on a few key market signals to avoid misstanding your moves. Every morning, pay attention to three major indicators. First, the US 10-year Treasury yield. If I continues to spike or exceeds the 5%, it means the hot winds are not over. You should remain cautious and mostly in cash rather than rushing in. Second, the VIX, the fear index. If the VIX surges above 30, it indicates the extreme panic in the market, which paradoxically could present a short-term oversold rebound opportunity. Since extreme emotion of means a turning point is here. Third, renminbi exchange rate. As long as the renminbi stays stable, it means the fundamentals and the liquid for Chinese assets still have support. Next is recommendation on adjusting your portfolio. Defensive strategy. In the current environment, consider raising the proportion of in cash you hold and allocating more to short-term government bonds. At the same time, look at the traditional safe haven assets like gold to hedge against the geopolitical risk and the market volatility. This defensive assets can act as a stabilizer for your portfolio during the storm. Offensive strategy focused on China's market while controlling overall risk. It's wise to also prepare for potential opportunities. You could focus on high-demanded sectors such as banking and energy as the foundation of your portfolio to gain strategy divided income and a defensive cushion. At the same time, keep an eye on leading tech and internet companies that were heavily sold off during the panic. If these high-quality names became deeply oversold in the short term, then as the fear subsides, they are likely to see a rebound spread mean reversation. These areas could lead the gains when the market stabilizes, becoming new points of growth. Let me summarize the core message today. Volatility is not risk. Permanent loss of capital is risk. Rather than being buyed by market emotions, use this round of volatility as a chance to optimize your portfolio. In fact, major shakeup is a litmus test for the resilience of your investment strategy. Now, I'd like to hear from you. Do you think the US market pullback has hit bottom, or is the decline just the beginning? Feel free to share your thoughts in the comments, and don't forget to subscribe to my channel so you won't miss future content. In the next video, we will dive into a hot topic, the latest developments of Chinese electric vehicle companies expanding overseas. Stay tuned.